And the meek shall inherit the stock market rally. The Dow Jones Industrial Average will have finally broken to the clear yesterday out of the shadows of the NASDAQ and S&P with a strong performance. It moved that index back above 29,000. But today, while our three major equity indices are floundering somewhat, although it's pretty clear that money is seeking out blue chip names, within the S&P 500, your biggest losing sectors for the year, they're coming on like gangbusters, led by financials, which maybe are finally living up to, well, they're universally loved as the best option in value. Individually, it's stocks associated with the reopening of the economy that are dominating the top 10 percentage gainers. This after the CDC reported their reports out that they want states to be ready for vaccine distribution on November 1st. Meanwhile, there are huge haircuts in the hottest stocks in 2020, but it is the question right now, is this simply an overdue pullback? And will investors load up again? There's a lot to delve into, so let's go straight to it. Fitzgerald Group Principal Keith Fitzgerald, Spotlight Asset Group CIO Shana Sissel, and 1847 Financials Greg Branch. Keith, let me start with you because for the last few weeks, you've been a proponent of riding out these mega growth stocks. And you and I both know from time to time they're going to hit these big air pockets. Have you made adjustments in the last 24 hours?
I have not sold anything, Charles, but I have gone shopping. You know, I'm not especially concerned because a lot of this is computer driven. Those things simply have to play out over the long term. These are bets that are digitizing our economy and are going to plow forward. So I'm very happy to buy at lower prices if I get the opportunity.
You know, Greg, at some point this has, by the way, welcome to Making Money. Glad to have you. At some point this has to happen. And from time to time, buying the dip has been a huge winner, not just this year, but you could go back to 2009, particularly when it comes to technology. Is anything different right now in your mind?
No, it's not entirely different. With respect to Keith's point, agreed, there are some sectors and some particular companies that have experienced a structural tailwind. But by and large, this is not very different from what we saw in 2010. And so in 2010 and 2012, what we saw is as the economy rebounded, other sectors outperformed tech. And if you believe consensus, when we start to look at calendar year 2021, consensus is expecting the S&P 500 outside of tech to grow at 35%, and it's expecting tech to grow at 15%. Really hard to justify a premium multiple when you don't have relative outperformance in earnings. That said, as Keith pointed out, there are. Oh, go ahead.
No, I was going to say on that point. Then you're saying that this time the rotation, which we've seen a lot of false starts in the last few months, maybe this is the real deal. And if it is a real deal, which areas, which names should benefit the most? Because it feels like everyone on Wall Street loves the financials.
Right. Right, and for good reason, Charles. You know, when I look at 2021, there are a couple of sectors that are going to exhibit triple-digit earnings growth. Financials is one of them. Some consumer discretionaries looks opportune as well, and some energy. But when you look at the financials, they're trading at a vast discount, you know, in some cases half of their typical price to tangible book multiple. And so when you combine cheap valuation with what looks to be 100% earnings growth next year, that provides an attractive opportunity.
Shana, let me get your thoughts here because, again, you know, we've gone through this. This is probably the most pronounced pullback we've seen in tech, but it's been a heck of a run. And everyone, we all kind of knew this was coming. But when it happens, that's when we start to ask, what's the next move? What's been your next move?
So I'm not necessarily negative on technology right now. I still believe that there's a huge change going on in our economy and in technologies driving efficiencies. I'm looking at not necessarily financials. Financials are challenged by the low interest rate environments that puts a lot of pressure on their margins. Yes, they are undervalued. Yes, they should revert to the mean. But in terms of long-term growth opportunities, it's not a place where I think has the tailwind that some other sectors do. For me, one of the areas of opportunities we're seeing is in some of the airline areas. When we think about this reopening trade, this rotation that's going on, you have to think about what's next for the economy. And as we continue to move towards progress of reopening, as virus news continues to be positive, I think that that's going to be positive for travel-oriented names, but airlines most definitely, because they're not as reliant on leisure and tourism travel to get more people on their flights.
they will have to see business pick up. And I'm glad you brought up that topic because we all know about the so-called wealth effect, right? Essentially, folks, that's when the stock market is at an all-time high, real estate's at an all-time high. And if you've got access to both, it feels really great, and it does have a strong influence on consumer behavior. However, think about this. If we layer on the possibility of a vaccine next month, the combination of a health and wealth effect, I mean, that should be monumental for the economy. Greg, I mean, how much would a vaccine change just the dynamics of everything?
It would change everything categorically, Charles. When you look at that jobs number, it really demonstrated that there's a sizable portion of our fellow Americans who aren't feeling any of those wealth effect factors. We have almost 30 million people still on some form of either state or federal government unemployment. And so what a vaccine does is it gives us a more robust recovery in jobs. And in order for us to stave off the pain of the evictions and the foreclosures that have been postponed until end of year, obviously with the hope that many of our fellow Americans will obtain gainful employment and be able to work themselves out of that back rent, back mortgage debt. But that all depends on a vaccine, and it all depends on the labor market picking up more robustly.
You know, and then, Keith, I would layer on to that the $3 trillion on the sidelines. You say, where does the fresh powder come from? Because even folks who are unemployed, they've been spending a lot of money. Of course, it's the fiscal policies of help. Congress is kind of blowing it right now. But what if we get that? The ultimate 1-2 punch in my mind would be the health effect combined with the wealth effect. If that does happen, let's say next month, for instance, how does that change the dynamics of this market?
I'd actually add a third piece. There's the health, the wealth, and there's the confidence factor. Because if people are confident and they're hopeful and we maintain that positive narrative, I think the market takes off like a rocket, because you've got optics right now in airlines and cruises, for example, that aren't going to return to normal until 2025. If you get a vaccine on the occasion, maybe that's next year. That's when that stuff is really going to go. The money's going to move, and I think it's going to be an amazing rally, even from these levels, if that happens.
I know people have taken like hundreds of cruises. They may go on one anyway. All right, listen. Now, everyone I know has been frustrated with the financial media's sort of disdain, right, for what's happened with the market. To a degree, though, they're taking it out on the retail investor, right? And this morning, for instance, Robinhood, we know under investigation now, apparently for selling order flow, which is something that's legal, but they apparently didn't tell clients early on. And then Quartz wrote a piece that's tied the practice of selling order flow to Bernie Madoff. I think the Robinhood crowd gets a bad rap. But Shanna, you actually say you are worried about these millennial investors and what they may be doing to this market.
Well, it's not so much that I don't like them as much as I'm concerned when I see young investors who have never really invested before getting into the market. You have this TikTok investor crowd, and you watch these videos, and they're concerning because they are well-meaning, but they're not coming necessarily from a place where they're educated, and that leaves them open for being preyed on. And so that's my bigger concern, is that the bad actors in our industry, and they exist, take advantage of this, and the Robinhood example is a good one. And so I'm a huge proponent of financial literacy for young people, and I think it's a good thing, but I am concerned that they're so into and enthusiastic about a market that clearly is a bit overheated.
Well, and to that point, I follow you on Twitter, and that might be a little bit of a different issue than, Greg, the overall issue of sort of that they're going to be met with doom and gloom. You know, I think they've done extraordinarily well, and we can't have it both ways. We want millennials in the market, but when they get in the market, it seems like there's a lot of people on Wall Street upset. Have they changed the dynamics for you of how you invest?
I'd say that they have an impact. Right. And one of the things that we need to watch and is, I think, a legitimate area of concern is the high correlation in terms of the names that they're investing in. And so when you look at market breadth, it has narrowed very acutely over the last few months. And that has often been a red flag. When you look at the other periods of narrow market breadth, it has been met with severe periods of underperformance. On the individual level, I worry particularly about the amount of leverage that they've been able to employ. And, we've all seen really tragic anecdotes of how this has affected people on the individual level. But on the macro level, there's also shadow credit, right? And so, in the midst of a rotation or a choppy downturn, how does that affect consumer spending and consumer confidence if one has drawn down all their credit trading? And that's something I think we need to be careful of as well.
Well, I think we're going to find out. Greg, welcome to the show. Shana, Keith, always appreciate it. Thank you all very much. Appreciate it.
Thanks.
All right, meanwhile, folks.